Good evening, ladies and gentlemen. Today we're going to take a look at trading bias and when it's a good thing to have one. Now, for newer traders, it's particularly useful not to have a bias as you're learning to trade the stock market, because a bias is an emotive response and trading on emotions is not a good thing to do. What I mean is, in CBA, let's say, everyone's talking about CBA lately about how overvalued it is or how they expect it to be overvalued. And even the brokers are all saying, hey, this should probably be around $100, maybe $110. Let's say you take a trade around here at this pop. You're expecting it to kind of just come off and start trending to the downside. And instead, it starts swinging back up. Now, a trader with a bias may hold onto that short position or may even add on as it's rising. Now, if you have a lot of capital and you have a good plan for this kind of trade, that's great, that's fine. But generally a trader who trades on emotion, trades on bias, doesn't have that plan. They just simply open a short, and that's adding on to that position isn't part of the trading plan. They just keep doing it as an emotional response because they're wrong, and they expect the market to correct over time and eventually end up in profit and all that sort of terrible trading habit stuff. So whether this is the daily chart or the 1 minute chart, it doesn't matter. A bias is a bias, and it's not particularly helpful to have when one should be sort of robotic in their response. One should look at the data, one should look at statistics and history of trade setups, and what to do, if X, then Y, and have a plan, stop losses, risk management, all that sort of good stuff. So yes, having a bias is terrible for newer traders, but I don't think it's terrible for experienced traders at all. So we're going to take a look at two trades that I had a strong bias on today. We have MIN and NCK, so Mineral Resources and Nixcali. We're going to take a look. You can see on the daily chart, these stocks sold down, so that's MIN, and this is NCK on the daily chart. So what we have is quite a big gap down, and as you can see, both stocks ended up rallying and not taking much more of a low shot to the downside, despite opening near the lows for the day. So both of them actually wicked up. Nixcali ended up closing a bit more green, as in it closed higher than it opened. But we'll take a look at the 1 minute chart for these stocks, and I sort of talk about the mindset going into these trades in the morning. So the stock's down 13% for MIN. Right? It doesn't matter what the news is. It's, the market is going, hey, we've got a 13% gap down. That in itself should be a red flag for, hey, this probably isn't going to be a positive day for today for the stock. I'm not saying it can't close higher. What I'm saying is it probably won't close higher than the previous close. So it can shoot higher, of course, as you can see in this example. It shoots up about $2.40-ish. But the mentality for this trade for me, for both of these stocks, was that I should not look for anything other than a short position. Can I take the opening drive long if it goes long? Sure. It's an option. But what I opted to do for this, to prevent any kind of chop, because what can happen is, you go multiple directions, right? You start short and then looks like a long, you go long, and then it becomes a short, and it just ends up being a bit choppy. So on a big move like today for both of these stocks, you can see that it rallies for 5-6 minutes. And the idea is to catch this stock and reverse it. So for me, it was a bias short. I was looking for where to enter short. And for something like MIN, round numbers are perfect. So gapping down, opened up at 39.79. For me, my first plan was the $40 round number, and it didn't surprise me at all that it wicked up above it at about a 30-cent spread at one point. So I was queued up, hoping to get hit on the spread because the idea was to go short. And of course, it did a lot of price action here. It shot up to the upside, hit 40.50-ish, 40.30, and then went right back down intraday in that one candle. And then eventually it recovered, and I had to close out that position by 10, 15, 20 cents, whatever it was. It shot up. It was just a starter position. It wasn't like, full size and balls deep or anything like that. So as it climbs, hits this 42 level and then stagnates. So the idea is to take a bit of a short there, because the idea is that This stock should not rally all the way to $45.86, which is the previous closing price. Can it do that? Sure, it's possible. I don't recall the last time I've seen a large cap stock or a mid cap stock gap down 13% and recover all 13% and then go green. Does it happen? Yes, it's a bit of a unicorn event. So, it's one of those things where it happens, but statistically, you're pretty fucking stupid if you just go long and expect it to gap fill. So, round numbers are always great for a denomination like $40. So, seeing it stagnate around this level is like, great, short. Where to take it? VWAP. Bounce off VWAP. Mentality is again short. Where does it short from? 40. Where does it get to? 41.50. The idea was to stay above this sort of stay below this level here, and the idea was to get short as it hits sort of this half number here, and the stop was in the 41.60. So I did not want to see it go above this level, and the idea was just for me to hold short and have this short bias and find a short trade. Now, if this stock ended up going through this level and then perhaps pulling back and going up again, I probably wouldn't take it. It wouldn't surprise me if something like this ends up just faking out and then going back down and just messing about. So I just wanted a clean short because a rally off the open from a stock that's down 13% is not surprising at all. This should not surprise anyone. I was trying my hand at a small short and then to add on if it kept failing. That's the idea. But I was wrong, re-entered, got it right again. And then of course it sort of double bottoms. And then from there it's just chop city. It kind of just does whatever. So the same thing happened on Nick Scali. This one had a huge rally. This one had a bit of spread and also very, very low shares in the book. So it was very thinly traded. So no surprise, it shot up at around 41.75 is where I got my first entry as it was coming off, because there was no way this was gapping down 8.5%-ish. And they're doing a full recovery. So this was kind of a blessing, actually, was seeing it pop this hard. And again, take it to VWAP, and no surprise whatsoever. Scale that in small parcels because there's really no other choice at this stock except to exit in 50 or 80 or 100 lots or something like that. So just small chunks at a time. So yeah, that was the idea for this one. And of course, because it trades so thinly, it's also no surprise that it doesn't hold VWAP. It sort of wicks below it. No surprises whatsoever for a stock that's so thinly traded. And then it just ends up just being chopped. So that was the trade idea behind these two stocks today, was to have a short bias and not look for, mind you, there was no long here, honestly. I know it looks fantastic to catch the upswing like this, but based on the spread, and I think there was like, at one point in the open, there might have been like 6 orders in the entire bid. So just completely untradeable in the first 3 minutes or so. And then the spread was large, the spread tightened, and then it reverses and then comes off. So it was just, I think this is a good example of where I apply having a bias to the short side on a stock that's down both 9% or so, and the other one being 13%. It's like, okay, the market is telling you the news that it's had, and it doesn't matter what the news is, the market's telling you the news is terrible. So then why would I not look for a short on a stock that rallies on terrible news? It's giving me the opportunity to make money the easy way. Now, some would say, oh, look, if something gaps down so hard, maybe I should take the long trade. And look, if you can find an opportunity in the order book, maybe it's stacked on the bid or something like that, and you can take a scalp from the open, or take a match trade that makes sense, sure, go for it. But for me, the easy money is looking for the short, looking for the reversal. And, that's particularly true when a stock is gapping down. Now, if a stock's gapping up, I'm going to look for the long side trade, right? On a pullback. The exact same thing, but the inverse. I think it's really important to understand that bias is not always a bad thing, as long as that bias and that mentality is backed up by execution. So, for example, if I started my short in this area here, I probably don't want to see it go back above this point in time. I'd have to cut. There are some people that are much better at this, more advanced, and have experience at front sighting. So as the stock is going up, they add shorts, but that's part of their trading plan, right? They have a structure, they have stats to back up their trade. And for me, I just did not have that for MIN or NCK today. For me, it was just look for the reversal, shop for it, execute it, take it to VWAP, take it around VWAP, because VWAP's sort of a nice little target for a pullback, and it's quite reliable. So MIN in this case ended up being a bit of a double bottom, but that's fine. Whether, that's also the next target. If VWAP ends up breaking, then the next target's going to be a double bottom. I did actually take the double bottom trade long, but ended up closing it as this happened here. So basically it's just coming back off. I was like, I'm just going to break even. I really shouldn't have taken that trade in the first place, but short bias, and that was the play for today. And I hope this was useful in some way for you in your trading. All right, guys, till next time. Peace.